Welcome to the Expert Circle, where seasoned financial experts share financial insights that are shaped by real experience. At LenDenClub, we believe that strong portfolios are built with strategic guidance. Here, the expert voices help navigate smarter financial choices. Narendra, welcome to the show. Good to have you.
Thank you so much. Thanks for inviting me.
So let's start with the basics. Tell us a little bit more about your journey.
So I completed a graduation in 2005 where I had an interest towards equity and personal finance because I did BBA. There was a specific subject called as business finance. I was fascinated towards equity shares and mutual funds. So got into a company called as Angel Broking initially and worked there for a couple of years. Then moved on with E&Y Ernst& Young in UK corporate tax, post which I always had this investment to pull back towards that. So I had an opportunity to get back to investments. So I was with Bharti AXA Life Insurance and sales. And then somewhere I felt that by selling a product, it's only what a company is asking you're supposed to do more than customization for a client. So I realized that if I change my role from a sales to a training, I can impact more people. That's where I felt, and I moved to a training team in Max Life Insurance.
Okay.
And I was able to make a little difference impact on the people because I was training a lot of managers and employees and then advisors of life insurance as well. But it was also over a period of time, I felt that it was limited. So that's where I took a decision to quit my employee journey and start off my own, because that's where I can really make a bigger impact for our investors, because personal finance is again very personal for each and every individual. So way back in 2016 started with the investments, and my company Capital Nexus was formed in that year, and post which today we manage close to 150 crores of investors money and close to 600 plus families we are managing.
That's amazing. So tell us a bit about how it is handling, training of students and other earning clients.
So training was again, as I said, I was with Max Life Insurance as a training manager, and I was training was always a fascinating thing. So got an opportunity with couple of colleges, Christ University, Jain University in Bangalore, where I was training people, graduates and postgraduates on a specific subjects which are personal finance, which could be sometimes on a London Stock Exchange subsidiary, which is also CISI. I was training on that, and then MBA students on a couple of personal finances. So
Yeah.
that's something was really a good opportunity. I did not take it as a full time, but since I had my own business and I was taking it as a free time whenever I used to have an opportunity. I was invited by a couple of faculties, so I was taking a sessions. It was interesting journey though, because in India we do not have a personal finance as a course for our
Right.
classes. Graduates have something called as business finance, and postgraduates also have something related to companies accounts, but not on a personal finance. So I was interested to train people in a younger age so that they don't make expensive mistakes.
That's absolutely right. So, what are some of the basic foundation pillars that you train with your students, and how forthcoming or how honest are your clients when designing a financial plan?
Okay. So basically, yeah, as I said, investments is something which has been there from quite a long time. But one unfortunate thing which is happening with the people just pass out of college, especially students today, because they get a package of 5-6 lakh rupees per annum at the same time, which translates to 50,000 rupees per month, and they have a credit card limit of 5 lakh rupees. You can imagine the way 50,000 and 6 lakhs is a limit. Their entire year package is given as a credit card limit, and at least 80% of them do not know how much credit card interest rates are charged. So that's something which is alarming situation, because people get into a mode all these years they would have dependent on parents, so they would have sacrificed so many things they feel. So they said, I have a credit card, let me buy iPhone, let me buy whatever fantasy things, and they end up with lot of debt, bad debt, because credit cards today charges as high as 42 to 46% per annum as an interest rate, which they'll understand really later. So that's where I want to inculcate a habit of what is saving, what is investing, and then what is debt, good debt and a bad debt,
Mm.
which needs to be practiced at the entry level of a graduates.
And what do you think are some of the most common mistakes that investors, NRIs, HNIs, even students make when
Yep.
investing?
So it's again because of a greed and fear are the two factors which influences any investor today. Because an investor might be, there is no limit for a higher returns. They say that okay, if some Market is giving us 20%. They say, why don't 25%? Is there any product which gives me 30%? This is a greed factor which influences. On the flip side, if we look at whenever market falls or a equity goes into negative mode, people say that, am I losing too much of money? This is a very big mistake which most of our investors make, whether it's a Indian NRIs or a students. The greed and fear influences a lot of investors. That's where people lose a lot of money. So that's something, emotions needs to be controlled.
Yeah.
That's where our role as a financial planners comes into picture. We try to educate clients what is greed limit one should have, and what is a returns realistic expectation from the market, and what is a period of time, how do they create wealth.
Absolutely. And I'm sure there must have been a change over the past many years in how investors look at, their investment behavior. How has that changed?
Okay. So investors earlier, things have drastically changed. Very interesting point you have raised. So people used to have a initial days. There were a lot of though investment opportunities were many, but social media was not so much. People were having a limited option opportunities, and then they were able to understand trust a advisor. But today things have drastically changed. Every now and then they look into social media, and things like Instagram, if you watch something, it keeps on repeatedly showing the same thing. So whether whatever the data people put in is available on Instagram, people do not really think that whether it's a fact or a myth. Just somebody said, I trust that. That cannot be the way, because there are Instagram influencers who have a millions of followers, and they say something, people start believing it. And those people promote something which are paid promotions for them, and people are getting badly influenced by this. So that's where really important changes, where people need to trust the advisor more than Instagram influencer or our websites.
Yeah. Speaking of which, there's so many, influencers, so many do-it-yourself websites. Why should investors come to you? What's the importance of a mutual fund distributor?
So basically, as I said initially, any point of time for an investor, it's always a personal finance matter somewhat, because the same dress doesn't fit everybody. Similarly, investment do it yourself could be opportunities, options are there, but people really have to understand one thing, which is their personal finance goals, because somebody's risk appetite is different with the other investor. The same, though they might be 20-year friends, but their risk appetite would be very different. Just because your friend has invested, you cannot blindly go and invest, because at the time when the markets are not doing really well, one person is looking at it as an opportunity, he might invest more, but the other friend could be very conservative, where he might feel that, okay, I'm losing it out, and they might sell it out at a loss also. So that's the reason personal finance is something very, very important. And secondly, there was a word called as FOMO couple of years back, and even today it's there. People say fear of missing out. Just because my friend invested, I also want to invest. That was fear of missing out. Today, as you asked the question, what people have changed is now it's a concept of FOFO, fear of finding out. People are really worried, should I really go and find it out? For example, if they get into any kind of a medical reports, they say that, okay, medical reports have come, they say that reports readings are little long. Doctor will ask for a further investigation. People will say that might lead to lot of psychological factors. They might feel bad, and they'll not go to any other doctors. Similarly, if I have to say a fire number, people say that I want to retire early, and if I have to retire early, have to have a specific planning in place. So people say that, okay, retirement is a far away goal, or it might be 10, 15 years away. Though the fear of finding out, people say that, why should I find out? If I find out, you will say a bigger corpus. I need 6 crores or 7 crores. That would be fearful for them. So they say that, let me not find it out. I don't need any kind of a retirement planning. I just invest based on my savings, which doesn't lead them to anywhere. That's a very important.
And can you share some real life examples how you've helped, a client gain or, prevent him from making losses?
Over a period of time, there have been many investors who have achieved a lot of financial goals. Basically, couple of investors have accomplished their kids' higher education and their retirement, buying of a house over a period of 10 years. Because as I said, financial plan is not just numbers in place. It's all about like financial horoscope. It gives you where are you presently, where do you want to reach, and what are the milestones in between. So to accomplish this, we do a holistic approach. In this holistic approach, it gives a opportunity to understand whether their risk appetite is fine, and we also calculate their existing investments. They might have a EPF, they might have a provident fund, they might have a insurance policies, they might have some postal deposits, bank deposits. Considering all this money into the goals, which will help them to see that whether they are sufficiently saved or not. That's very important. So considering these parameters, we'll also create a portfolio which will help them to attain their financial goals.
Okay. And since you have goal based investing as an approach, how does P2P lending fit in?
Okay, so P2P as a product, we are looking at a product in a debt category. So in investments, there are four categories: equity, debt, real estate, and commodities. So P2P comes into picture where it is all about a debt component, because it gives a regular returns and with a low risk appetite compared to equity. And the debt category, there are bonds available, debentures, non-convertible debentures, which are fetching close to 9 to 10% as a returns. But P2P, with all RBI regulation coming into place from last 13 years, we have RBI regulation to rules and regulations for all the P2Ps. So with that regulation in place, P2P has been relatively giving a higher returns over a period of time. So that's where for a short-term investors, like less than a year, P2P plays a bigger role, whereas non-convertible debentures or bonds gives a good returns over a period of 3 to 5 years. If somebody is looking for a short duration, we give them P2P.
So, what is your control measure for allocation to P2P?
Okay, so control measure for P2P is diversification, because with the diversification, if an investor has to invest 10 lakhs, we might not suggest all the 10 lakhs to one time of allocation. It would be spread across minimum 300 to 600 borrowers. So by having this virtue of diversification, they'll reduce the risk to a larger extent. Considering NPAs in the last couple of years, after all the NPS and expenses, our investors are able to make 12 to 15% as a returns from P2P.
Okay. And how did you start working with LenDenClub? What has been your journey like?
It's been 3 years with LenDenClub, and they've been doing really well. And all our investors have made sufficiently good returns in a debt category. As I said, there is no upper limit. People expectation might be 20-25%, but realistically, 12 to 15% returns have been delivered from last 3 years. And with that confidence, I've also put in my money in the beginning just to test the waters, and it has been done really well. Post which we have advised our investors today. Close to around 70 to 73 lenders are there with us who have lended it to Lendin, and it's been doing really well for them.
So, how would you want to promote awareness for P2P lending, bust some myths?
So P2P, as especially there are mutual fund distributors who are really thinking about whether should we really suggest this to our investors, because there have been lot of news around P2P, because it's just a nascent market for India. P2P has been just around 10-12 years, whereas in other countries, developed countries, P2P is there from 60-70 years, and it's been doing really well there as well. Like US, for example, the bank deposit rates are at 3 to 4%, not beyond that. That too post COVID, it's reached a level of 3%. Earlier, it was 1.5% as IFD rates. P2P there is in a range of 7 to 8%, whereas in India, banks itself are offering 7 to 8%, and P2Ps are offering somewhere 12 to 15% is a great thing. And this is only a beginning. Over a period of time, it is because in unorganized markets, there have been lot of people who have been doing this, and they might lose it on the principal component also. But P2P platforms have been so regulated, and they also taken a lot of measures towards operational side and as well as recovery side. It has been delivering a very good returns to our investors.
Okay. Any specific advice for the mutual fund distributors who are sitting on the fence about, working with LenDenClub?
Yeah, definitely, it's a good opportunity for them to diversify, because today, honestly, investors, whether if you do not give somebody else or they will investors themselves go and borrow it somewhere and they invest it. So that's the reason, always add it as a portfolio, understand it well, and then advise it to your clients based on the asset allocation. It's not that all the money of theirs should be put in P2P. At least 5 to 10% of the asset allocation should be done towards P2P, which gives a short-term flexibility and as well as good returns compared to debt funds.
Absolutely. Thank you so much. It's been interesting learning about your journey, your outlook on asset allocation, the training, and of course, your view on P2P.
Thank you so much for inviting.
Thank you.